How defensive should investors be then in this kind of environment? And are utilities, healthcare, staples, the usual suspects, the default proposition now?
Yeah, it certainly feels as though the Fed is doing its job and the economy is slowing, and that's a feature, not a bug. And I think Rick Santelli hit it right on the head with what happens after a Fed meeting, which we just had, and what transpires next is a parade of Fed speakers that really want to adjust consensus around where Fed policy is heading. And what had happened after the July meeting, where the Fed raised 0.75 of a percentage point, was that our expectation was that they'd get to 3.25, 3.5 by the end of this year on the Fed funds rate, and then they would start to pivot next year. And I think that the parade of Fed speakers this week has done a pretty good job of pulling that back in or tamping down those expectations. So if in fact you believe the economy is slowing, and if in fact, which is likely the case, and that's what the Fed's trying to make happen here for us, it's better to own things that are things that you need versus things that you want. So you hit it on the head when you think about healthcare, consumer staples, utilities, the telecom operators. But I would also argue on the other end of that spectrum, some of the last things we're going to give up certainly is our cell phones. So I think that the Apple trade remains pretty strong. Our connectivity at the office place. So Microsoft remains pretty strong. I still think there's a great opportunity on Alphabet. So I think you can balance both of these things off. You can be defensive on one side of your portfolio and make that your sort of defensive, counter-cyclical, and on the other side you want to have that growth, but growth at a reasonable price and something that's measured in a price to earnings.